Oh, here we go, chat. Right, just want to make sure I don't miss any questions. Okay, good. I think we're ready to go. Thanks for joining me. If you don't know me, my name is Jason Sen, and I've been trading since 1987. I post quite regularly on FX Street most days. Hang on, how do I put this back up? There we go. So hopefully you've at least read some of my analysis. Any questions? I really do want your questions, and I do want your comments. So please don't be shy. I'm going to start off with gold today. I am going to move. I promised to go through the dollar pairs and the yen pairs, which I will do. I must admit, I'm finding them very frustrating at the moment because we don't really have trends to jump on. There's lots of this sort of sideways stuff going on in most of the financial markets at the moment. It's all the ones that I cover: Forex, the yen pairs, the dollar pairs, gold and silver. Oil's actually on the move. That's one market that is on the move, and even the stock markets are stuck in sideways ranges, which I'm finding very frustrated. You know, this kind of sideways chop isn't what I'm looking for. This is the daily chart for gold. I've talked about a potential triple top pattern here for a very, very long time. This goes back to 2020. It's not playing out on the downside yet. We did obviously have a move to the downside, but we had this V-shaped recovery in gold. So, you know, if I, as a trend follower, I'm really struggling because you know, we're not really in a long-term, well, the long-term trend is sideways. So the only thing I've really got to go on at the moment, I'm going to move this up. I've been talking to my subscribers about this for a little while, and it has played out, which is quite handy. I'm actually going to record this so that I can show it. Okay, so looking at gold, and the thing that I've had my eyes on with gold, because in the longer term, we're just in these sideways trends. So that was the weekly chart I showed you with the triple top, potential triple top. Now, this is what I'm focused on at the moment is for gold in the short term. I've really had to go into the short term to find trade opportunities. And this is the 1 hour chart. But I've talked about this, and I have actually posted this on FX Street, I'm sure. So if you've been following my analysis, you'd probably be aware of this already. I've talked about this head and shoulders pattern. So we have the potential left shoulder here. This is the head. And note how we have even a double top head there. That's actually not uncommon to see in a head and shoulders pattern. Little double top there as the head. And then we dip down, which gives us the neckline and then the right shoulder. Now, the neckline came in at around 1975 this week, actually a little bit higher, 1977. So for me, the break below 1973 was my sell signal, and down we go. Now, I could even argue that we have, and this often happens with head and shoulders patterns as well, by the way. It's playing out quite nicely. This, I could even argue, well, it's not much of a right shoulder, so maybe it's not really fair to say, and these are all, you know, down to personal interpretation, aren't they? But I could argue that this is another right shoulder. I'd rather it was rather the rally had gone up to sort of 1980, 1985, and then turned around. That would have been a far more convincing right shoulder. But I'll just leave that down to your interpretation. You're not seeing my cursor. Okay. Not sure what to do about that. Screen not moving. Okay, hang on a sec. So can you not see the 1 hour chart now? I'm opened it up a bit. Okay, can you see now? I've got the, yeah, okay, you can see a 1 hour chart. Okay, I don't know what, I hope this doesn't happen again, but we'll just crack on. I'm going to record it. Okay, so on the 1 hour chart, I'll start again. We have a potential left shoulder here, and we have the head of the head and shoulders pattern here, which is in fact a double top pattern as well. And as I said earlier, that is not uncommon to see a double top as the head in the head and shoulders pattern. We then dipped down and had another rally up, which didn't quite make it to the previous high. So I've taken that as the right shoulder, and therefore we have the neckline in the mid 1970 area. We've broken down through that yesterday to complete the head and shoulders pattern, and we've gone down to 1955. Now we've tried it, we've struggled to have a little bit of a rebound here, but it's not really happening for the bulls. And as I said earlier, I could argue that this is perhaps a second head and shoulders pattern forming. Now, I would have liked to see this potential right shoulder here really more up around the sort of 1975, 1980 area. That would have been more of a convincing right shoulder. So I could argue it is, I could argue it isn't, but ultimately, I suppose the most important thing is that here you can see that this peak is certainly a lot lower than the previous peaks. So gold is carving out something of a very short-term bear trend anyway. A correction at this stage is what I'm going to call it. Okay, so if we join these two lows here, we have a trend line which I'm going to call, it's a potential neckline to a second head and shoulders pattern. And the thing is, if we break down from there, we have a 50 near 55 point drop projection for the measured target. So that really could take us down to 1900, and that would be just around the 50% fib line. So perfectly reasonable to project a move down that far. It's, you know, it's not an exceptional move. And if you notice on the 1 hour chart, we do also have the green 500-hour moving average, and that does tend to work quite well as support and resistance levels. You can see here it caught this peak. I'm just going to scrunch the chart up a bit more, see how well the green 500-hour moving average did as support and resistance. Well, look, I think historically I can argue that it can be quite a good support and resistance line. Acted well as support here and resistance here. The market dropped from there. You know, it was a good resistance level on the recovery. Eventually we broke above it and it did act as support. You know, you can see for yourself how the green line has been pretty reasonable at being a support and resistance line. So we'll see what happens. Right now, obviously, the 1955 area is going to be important. A couple of swing lows there joined them up. As I say, could argue this is a bigger head and shoulders pattern, and a break below that, the neckline and the green 500-hour moving average, I could certainly argue would push us down to at least 1933, 1932, which would be a decent fib target, but 1910, 1900 is not out of the question. I'm just going to read this question from Yoel. Please address and enlighten me on lot size. I learned from you in one of your interviews that you risk 1% of your capital. I want more clarity. Should it be 1% per trade or 1% per day? I'm asking in the case of having to open more than 3 to 4 different trades at a time. Okay, this is a good question, actually. How do we get access to signals? It's just been shared on a sheet at investing.com. Yeah, okay, so first of all, let me answer your question. This is my rule, and it's also a general rule that you risk 1% on each trade. Now, 1% might not seem like a lot. If you've got a $10,000 account and you're only risking $100 in an attempt to make $150 or $200 on a trade, some people don't think that that's a lot of money, and you should be risking more like 5, 6, 7% on a trade. Well, that's all very well if you're winning and you know you've got a good run and you're doing well, but of course all traders, me included, we have bad runs. We'll have times when we'll lose 3, 4, 5 trades in a row, maybe more. And now if you're risking 1% and you lose 6, 7 trades in a row, you're only down 6 or 7%. That's not going to cause you sleepless nights. It's not a position that you're going to struggle to recover from. If you get 3 or 4 winning trades, you'll have the money back. Now, let's say you have a disastrous run and you lose 12 trades in a row. Not, you know, again, not unheard of. You're going to be down 12%. Again, it's not a situation that you can't recover from sooner rather than later. But if you're betting, if you're risking 5% on a trade, and obviously you have 7 losing trades in a row, you're down 35%. Now you're talking about a significant amount of your account. You've lost a third of your account. So, you know, you've got to then make 50% of your account to make that money back, which is why we traders try to keep control of their accounts by keeping the risk under control, making sure you don't get in a big hole. And it's not only the monetary loss that is the problem. Of course, if you end up 30% down on your account and you know that you've got to make nearly 50% on the balance now to get the money back, your confidence is going to be blown. You're going to be emotionally and mentally in the wrong place. You're going to really struggle. You're going to be panicking. You know that you can't really afford to lose much more money. So this is why the 1% rule, I think, generally is a good one to stick to. Just keep things under control. Try to build the account relatively slowly. You can still make 4 or 5% in a week. You could still potentially make 20% in a month. I mean, that would be a very good month if you did that every single month, obviously. But so you know, if you've got any more questions on that, but that is the logic that goes behind it. If you did just ask me about where you can find me, so I'm going to give you that. That's my website. And if you Google my name, I'm pretty easy to find on the internet. Okay, so we have a potential move to the downside in gold to at least 1935, 1932, and even 1910, 1900 would not be out of the question. On the upside, what do we need to see? So we do have some resistance. I could argue it's a little bit tricky. I'm looking at these moving averages, and we've got the 100-hour moving average at 1979 and the 200-hour moving average at 1984. I'm actually going to take those levels because these moving averages also straddle the neckline that I have there, the break point, which did send the market down significantly lower after that. So I'm going to suggest that sort of 1980, 1985 is the level to watch on any bounce. Now, if we do bounce there, as I said earlier, and we hold it, that really would make for a nice second right shoulder of this possible head and shoulders pattern. So just keep an eye on that. If we start breaking above 1890, I'm going to give up on the idea that gold's going down, and that would either mean we're going to be stuck in this range, which I really hope we're not, because I don't like that, makes life difficult, or we're going to break above 2010, and this will be seen as a sideways consolidation pattern, and then once we break above 2010, the next leg higher has begun. The cursor stopped. Okay, I don't know what to say about if the cursor's not moving. I'm giving you the levels there, so hopefully you're taking note. I'm going to now move on to silver. There does seem to be a bit of a delay. Maybe I've got a weak internet connection. I'm actually traveling as usual, and I'm in a hotel room, so I don't know whether the internet connection is slow. Okay, what do you not understand? Please tell me. Do you not understand my gold analysis, or do you have a question about something else, or do you not understand about the 1% risk trading rule? Okay, while I wait for gold to reply, can you now see the silver chart that I've got on the screen? I'm actually going to switch to a daily chart for now. Okay, so the key levels on gold again are 1955 is key. It's the two swing lows are at that price, and we also now have the green 500-hour moving average there. So a break below 1955 could send us down to 1935, 1932, and I'd suggest that a break below 1930 could take us as far as 1910, 1900, that sort of 10-point area. For me, that seems the most likely scenario because it does seem like we're in a correction phase. Whether that turns out to be something more significant to the downside, I don't know at this stage, but judging by the pattern, we said those would be the targets on a break below 1955. Now, if we start to recover, I'm seeing probably the most significant resistance around the 1980 to 1985. Share the gold chart again. Okay, let me get it up now. Right, I did switch to the silver chart, but I'm going back to the gold chart now. This is actually the daily chart for gold. And you can see really how long we have been in this sideways pattern. The head and shoulders pattern I'm showing you on the hourly chart is just this tiny little area on the right hand side where I've got my fib levels. So, you know, I was only looking at a couple of weeks worth of data when I was looking at that head and shoulders pattern. It really is very small on the grand scale of things. And when you go to the daily chart, you can't even see it. On the daily chart, all that you can really see is, the most important thing are these three peaks here at the all-time high for gold. And I could argue that that's a triple top. The thing is, we'd really need to break below 1600 before the triple top is confirmed. And then we would have a drop to 1300 as the projected target. But this is obviously a long way off because we have to drop 350 points before we break the neckline of the potential triple top pattern. I could draw a trend line kind of here. There we go. We may just be stuck in this channel. It's perfectly, you know, it's reasonable to suggest that we're just going to trade within these parameters from sort of 1550 up to 2050. It's really difficult to get anything decisive from gold now because we have been trading in this sideways pattern for so long. Okay, I'm going to move on to silver. Okay, that is the chart for silver. Now, this is also the daily chart, and you can see, I mean, if you can make sense of this pattern, then I'd love you to tell me because I can't. We really are just stuck in this horrible sideways chop on the daily chart. We're having, I can't even really put trend lines on here that I would rely on. If I go to the hourly chart to try to find something, then, well, look, you know, we're just in this sideways pattern. I've put some trend lines on here to try and make sense of it, but really this is just a short-term scalpers market. So I thought I'd show it to you. I'm going to stick with commodities and I'm going to show you the oil market. Okay. Hopefully you can see this. This is the 1 hour chart for oil, which I will just scrunch up a little bit. Okay, so these are my old fib lines, which I'm going to take off. So we've had a pretty decent drop. We started falling around to the peak. Why do I often use weekly, daily and hourly charts? Okay, so if you're a short-term trader and you're focusing on, for example, 30 minutes, 15-minute charts, that's all well and good. If you're holding positions for maybe an hour or two, then those time frames can work fine for you. But the thing is, if you're scalping gold and you're only really interested in taking 5 points out of it, maybe risking 2.5 points to make 5 points, then you're not going to be too bothered about the longer term charts. You're in, you're out, you're in, you're out. But you do have to be aware of longer term levels. In fact, It's a good question. Let me demonstrate what I mean by that. Okay. So I'm going to put a chart up now for the pound versus the US dollar. And I am going to show you the weekly chart. Okay. First, I'm actually going to flick to the daily chart. So let's say you are trading cable and you are a trend follower and you're trading short-term charts. And even on the daily chart, going back 1 year, you could see that basically cable was in a nice bull trend, nice steady bull trend, punctuated with the usual sort of consolidation patterns, flags, triangles, pennants, that kind of thing. But if you're trading on the bull trend, you'd be thinking, this is great. The pound is in a nice strong bull trend against the dollar, and I'm happy being long. Now, let's say we'd got to July. Let's say we're here. And you're looking back over the data. You can't really see any reason why we won't keep going. There's no, we've just about managed to beat all the important moving averages. That we bought the 200, the red, the 100 is the blue acting as a good support level. You could see that we've even broken above the 500-day moving average, just managed to get above it. We came down to retest it. Every time we broke above one of these levels, look, we broke above the 200, the red 200-day moving average, and that managed to work as support. We broke above the 100-day moving average, and that managed to work nicely as support again here. We broke above the green 500-day moving average, and look how nicely it worked as a support level when the market came down to retest it. So as a trend follower, you'd be thinking, okay, this looks really good. I am going to continue. I'm going to hold along, or I'm going to continue to buy into any weakness. That trend line even works beautifully. Look how it catches the retracement, especially here where it caught the pull back to the 100-day moving average. Beautiful. There's absolutely no reason to suspect that the cable is about to turn around and go down. But what you wouldn't have seen is in the weekly chart. Yeah, I think FX Street are recording it, so they will post it afterwards. Now, when you go back to the weekly chart, just going to get rid of that screen. Hang on. Let me close this. Done. Edit. Okay. There. Right. Now, when you go back to the weekly chart that goes back to 2014, you can see this enormous trend line. Actually, I'll go back even further. Now, when I go back to 2007, just before the global financial crisis, cable actually peaked at 211.61. Can you believe that? The market then crashed. So by the time we got to 2022, the low in 2022, the market was already in a 15-year bear market. So the trend was very, very obvious. We were in a significant longer-term bear trend. So this bounce that I showed you on the daily chart that looks so strong, so impressive, and so important that we should be trading cable from the long side only was really just a blip, just a small recovery in that longer term bear trend. We peaked here around the 23.6% fib and also my shorter term fib, the 38.2% fib, both of them around the 129.00130 area. We did peak above the 200-week moving average, but we only managed to close 1 week above it. And then we've also got this trend line going back to 2014. So that trend line was an 8-year trend line. So we've got 8-year trend line. We've got Fibonacci levels going back 15 years. We've got the 500-week moving average. Okay, that was a good 600 pips above the level, but it was obviously another resistance level that we would have had to have taken note of, adding pressure to the downside. And look how well the green 500-week moving average caught that peak there in 2021 and caught that peak there in 2014. So there was going to be a very good chance that that green 500-week moving average was going to catch this bounce too. Now, if you didn't look at the weekly chart, you would be completely unaware that the longer term trend is down. We were hitting important longer term 15-year Fibonacci resistance levels, 200-week moving average, and getting close to the 500-week moving average, and then also 8-year downward sloping trend line. If you wouldn't, you can see why now that cable has turned around and gone down, and you can see why we probably will continue to trend lower for the foreseeable future. So does that answer your question? That's why you've got to look at weekly charts, because if you were looking at the daily chart, you might have been buying it, for example, at the 500-day moving average, at the 200-day moving average, at the 100-day moving average, not aware that the longer term picture was so negative. And then you'd be thinking, why do we keep breaking through these support levels? Well, the reason being because the longer term traders know the cable's probably going to go down. And even now, so let's have a look at this pattern. What do we make of it? Is this a bottoming pattern? It could be. It could be. The consolidation pattern was probably like that. That's probably a triangle. We have broken to the upside, but the thing is, we were caught by the 500 and the 200-day moving averages now that we've broken below them, and we've reversed really quickly from there. And we've also got something of a, what could I call that, shooting star candle, and then we've obviously dropped off significantly from there. So the question now for cable, if you're trading cable, is do we hold 122.30, 122.20 and start to rally? Anyway, that is why you should keep an eye on the longer term charts, just in case you think that we're in a good a good trend and you're missing the bigger picture. Okay, is there any other markets that you want me to look at? I've started with cable, so I might as well stick with dollar pairs, and I should really look at the euro. Actually, do you know what I'm going to do? I am going to look at some dollar pairs, but I'm actually going to start with the dollar yen. That's a good suggestion. I'll look at that one. But I'm actually going to show you the oops, not that one. I'm going to show you the dollar index, something I keep an eye on just to get a feel for where the dollar's going. Right. Now, this is not particularly, what's the word, clear. So I'm going to isolate what's happened recently. The dollar index has been rallying, and I thought this was a consolidation pattern and that the dollar would then just continue higher. But on Friday, we had the non-farm payroll number out of the US, and it was weaker than expected. The US created 150,000 jobs, which is still pretty impressive, but the expectation was for 180,000. And so when that number came out, and the market read it that the Fed would pause or even no longer, or even forget further interest rate rises. And look, the dollar absolutely collapsed. Big move down for the dollar index. We dropped from 106.22 to 104.94. So we had a 125 pip drop, very significant. We'd even broken this lower trend line, which I thought was important, significant. Really, I was hoping that this was the beginning of a trend, a bear trend, something I could actually get on and run something for more than 2 or 3 hours and see perhaps a move to the downside, 104.40, 104.10, something like that. But again, it was not to be. The dollar has recovered this week significantly. In the last 3 days, we've had a really good recovery from a low on Monday of 104.84 up to 105.84. So we've had a 100 pip bounce. That's a big move, and it's been on nothing because we've had no data out. The only significant data we've had out was that US non-farm payroll number and average earnings. And I don't know, so this unfortunately just emphasizes the fact that uh, these forex markets just don't have any clear direction. I could put a trend line on there. Maybe we'll see if it holds. And I'm finding it frustrating because a market that collapses with a big red candle and looks like we're beginning a trend, and then just there's no reason at all for me to buy the dollar down here. I can't see any reason. There was nothing telling me. I'm just going to put some Fibonacci levels on there just to make sure they weren't telling me to buy it. No, they really weren't, because we've broken the 23.6% fib at 105.50. So the least I would have expected would be to go to 104.40. Anyway, this is why it's quite difficult at the moment, and a lot of people are struggling because you just can't run a position for too long, and some of the levels don't really work, if that makes sense. And then when you look at the dollar index, of course, you can see we've just been in this sideways movement for quite a long time, for at least a year. Okay, let's get on the dollar yen. Okay, dollar yen. Right. We are in a situation where you have to wonder if, again, this is another reason why you have to look at the weekly chart. Going back to Frank. Okay, Frank, if you were not looking at the weekly chart for the US dollar versus the Japanese yen, you would not be aware that last year, in fact, a year ago in October, we had a peak of 151.94, and then the market dropped significantly, didn't it? Dropped about 25 points, about 2,500 pips. Now, we've had a decent climb up from there to retest the previous high, and we've got noise coming out from Bank of Japan saying that they're not happy about the weakness of the yen and they want to stop speculators pushing it down even further. So for now, at least, we've found a peak at 151.74, 20 pips lower than last year's high. And of course, I could argue that this is a very large double top pattern. And again, if you didn't look at the weekly chart, you wouldn't know that we had quite a negative candle last year at that price. The market probed up. We'd had some really good green candles. The market was looking pretty strong. Very big green candle the week before the market reversed, and then pushed up, but we were left with this long upper wick, small red body, and from there the market collapsed. That candle was your indication that the market had peaked. We haven't got something quite as significant as that this time round, but yeah, well, maybe I could argue that it is significant enough, because you can see that that candle that we had last week as we retested the previous high. There was a pretty good rejection of that high. We halted 20 pips from last year's high, turned around, closed down on the week with a long upper wick. So we've got a shooting star candle there. We've got a doji previously, two dojis previously, actually. Well, actually, look, quite a series of dojis, really. So there is definitely some indecision there from the bulls. They are not as confident as they were, judging by the candles on the weekly chart. So I keep saying it, but that's why you want to look at the weekly chart. Overbought on the weekly chart as well, if you look at the slow stochastics. Okay, now what do I want to do? Let's go to the daily chart. Now the question is, the Bank of Japan has not intervened, but it's sort of widely whispered that 150 is the line in the sand, and they don't want to see the dollar yen much higher than 150. We've had a really good bounce back now from the previous low. This daily chart really isn't telling us much. There was so much hesitation on the as we approached 150. Look, there was barely any movement for about 2 weeks. The daily ranges were so small. Then we've got this burst up, and then anyway, now the one thing that I would be watching if I were you on this dollar yen chart is, again, a potential head and shoulders pattern, and this is a really nice one. This could really work. Okay, this is the hourly chart, so I'm only isolating what's happened since October. Now, there you go. There's your neckline. I think it's fairly obvious. We've had a good run up, as you know. a very clear left shoulder. I don't think there's any argument there. Let me do this. Really spread it out so you can see it. Oops. A nice big head, so a deep pullback, and then we rocketed to form the head of this potential pattern, and then another big slam down to hold just above the previous low. So the question now is, how high do we go? Do we turn around quite soon and turn and form the right shoulder to this pattern? Now, I had a little bet that that would happen yesterday. I had a little bet around sort of I think it was it there? 150, yeah, around the low 150 area. I thought maybe the hourly moving averages, the 100 and the 200, coupled with the 38.2% fib, I thought maybe that would hold it. And we'd have a small right shoulder and then break the neckline and down we go. But actually, where the dollar has found some strength from somewhere, I don't really understand why it's pushing higher now. But clearly it is. We've even got through the 61.8% fib. So it's a case of sit back and wait now. I don't know what to do. This is kind of no man's land for me. We're clearly pushing up. I don't want to sell it blindly now. So I'm going to have to wait for a pattern to develop. And if we do turn around relatively soon, and then we will see if we can form a right shoulder. But other than that, I've got nothing to go on. So I hope that's helpful. That's what I am watching that. I will trade the pattern if it does form. But as I said, we've already beaten the peak of the left shoulder, which was at 150.77. We're about 20 pips above that now. It doesn't matter. We can still peak above that. The right shoulder can be taller than the left shoulder and still be a relevant head and shoulders pattern, and they don't even have to be symmetrical. Yeah, that's what I would be looking at. Back to center. Now, if we break above this, the other danger is being long the pair. Let's say we break above 152.00, you have to wonder. There's going to be, people are going to be nervous. People are not going to be comfortably holding a long position, despite the fact we're in a bull trend and we'll have beaten the previous high at 151.94. Because you're going to wonder, when is the Bank of Japan just going to suddenly wake up and go, right, we've had enough of this, bang, and then knock it 500 pips. That's something that you've got to be wary of. There are other dollar pairs which are pushing higher. Sorry, there are other yen pairs which are pushing higher, I should say, other currencies against the yen. So the euro is now moving up, and that hasn't triggered any response from the Bank of Japan. Maybe they're not concerned about the euro. Maybe they're only concerned about the dollar-yen rate. I don't know. But look, you can see, again, that could have been a double top pattern, but it wasn't. So whether that's an indication of what will happen with the dollar-yen, I don't know. But that could have been a nice little double top pattern, or almost symmetrical, but we've definitely pushed up through there. Nice big green candle. This was a bit confusing as we broke the peaks as we pulled back, but now we do seem to be settling quite nicely above 160.00 and those two previous peaks. So that the euro yen does look quite strong. Don't argue with the bull trend. Definitely in a longer term bull trend. Do you want me to have a look at any other yen pairs? Some of them are really messy. Aussie yen, if I remember correctly, is horribly messy. Oh, actually, look, this is worth noting. Okay, Aussie yen. Daily chart. In something of a bull run, but we have been consolidating for 18 months. Now, we're just testing the upper trend line, so if you fancy a little bit of a gamble, Swiss yen, yeah, I can look at that. If you fancy a bit of a gamble, this could be worth trying, actually. Look how we have, right, okay, let me just, we're testing the upper trend line to this consolidation pattern, which goes back to September 22, so just over a year old. Now, we try to break above there, but look how we have this bearish engulfing candle. This is pretty important, I think. These candles can be worth paying attention to. So yesterday we pushed up through the previous high and we managed to reach 97.59. The bulls would have been thinking, okay, here we go. We've beaten the previous day's high. We're making a good break above this trend line. It's probably time to get long. and they would have got slammed. I think it was actually the Bank of Australia. They did hike rates a quarter of percent as expected, but then I think the rhetoric was quite dovish and suggesting that that might be the last rate hike. Something like that happened in at the Bank of Australia meeting yesterday. Royal Bank of Australia, I think I should say. So we took out the previous day's low, and we even took out the opening price on Monday. So hang on, sorry, no, that was Tuesday. So that was Friday. We closed below the opening price on Friday. We didn't close below the Friday's low, but that is a bearish engulfing candle. So I'm wondering if that signals now that the Aussie will continue to weaken further against the yen. So this, I don't know, this could be a trading opportunity. Look, we're trading at 96.94. Yesterday's high was 97.60, 97.59. If you think that this is something that's worth trading, if you think that it's worth taking a gamble that we will reverse again from this trend line, and the bearish engulfing candle certainly would give you some confidence in thinking that might be the case. We're very overbought with the slow stochastics as well, and they're turning. Then maybe this is a relatively low risk trade, because of course, if you're prepared to risk, say, 70, 80 pips, whatever it is, with the stop above yesterday's high, the downside is very significant. I mean, we wouldn't have to, a relatively small drop would take us to 95, will take us down easily 160, 170 pips. So that alone would be a trade that's 2.5 to 1 risk reward, and that doesn't even take us to the middle of the channel. You see what I mean? So yeah, exactly. Several Aussie dollar pairs dropped significantly. They whacked the Aussie yesterday on suggested dovishness from the Bank of Australia. Well, look, there's a trade opportunity if you fancy one. As I said, it's only 80 pips stop loss, and we could be looking at, we could easily be looking at 200 pips on the downside without too much trouble. That would only take us to the blue 100-day moving average. There's an idea. Okay, Swiss yen. That's something I haven't looked at for a while. Okay, let me just get it on my ticker. CHFJPY. Okay. See, Swiss yen. Let's have a look. I haven't had a look at this, so I don't really. Okay, well, very clearly in a bull trend. Don't think there's any argument about that. The yen obviously been weakened against almost every currency. That's one heck of a bull run, isn't it? So the question now is, can I find a pattern which suggests that the bull run will end? And no, I can't. I wouldn't short this. I wouldn't short this at all. The data's quite gappy. I guess the Swiss franc doesn't move much, and the Japanese yen doesn't move much either. Look, all I can say is that we're in a very clear bull trend. We're even holding the 50-day moving average. There is nothing that I can see to indicate that this is going to turn around. So there's no pattern in particular, and that's all I can really say on that one. I'll have a look at the dollar CAD, probably the last one I'll have time for. Let's have a look. Right, this has been really confusing. I'm not going to lie. Again, we have to have a look at the longer term chart to have any idea of what's going on. Oops, scrunch it up a little bit too much. So this is the bit that's relevant to me. This is, again, look, this has been horrible. Actually, let me just go out again. If I just isolate what's happened over the last year, now how on earth do you trade that? Up, down, up, down, up, down, all over the place, peaking at different levels. That trend line did work for a while, but then it failed. We didn't quite get down to the lower trend line there and touch the 500-day moving average, although I'm pretty sure I would have had a buy level down there. You would have had to have done, wouldn't you? buying a trend line and a 500-day moving average. So it's been horrible. And the only thing that I've got to go on is this trend line that goes back to 2020, February 2020. So that's 3.5 years old, that trend line. Now, this was horrible again. This fooled me completely and I did lose money. It looked like we'd broken above the trend line. We closed above it and then we just turned around and sank. So I was buying it at the trend line thinking, right, this is it. We've got a breakout. Market tumbled now and then it came back and it just hovered 3-4 days around the trend line. No one knew which way it was going to break. I'd given up by then. I'd lost money here and I thought, well, I'm not getting involved here. I don't know what's going on, thankfully, because I probably would have lost on 3 or 4 more trades if I'd got involved trying to guess what had happened. Now, we've got the breakout at last. We beat the previous peak, the October high, or we had the early October high. We beat that in late October. So surely you'd be thinking, right, we're going to go now. We've broken out of this 3.5-year trend line. That should be significant. But the market then just chopped about for 4 days and collapsed. So I don't know what the heck's going on. We've dumped back below the trend line. This time we held the 50-day moving average and we're taking off again. If I had to put a trade on right now, I'd buy it because we're in a bull trend and we have retested that trend line so many times and bounced off it. I would have to be long rather than short, but you can see how tricky it is. This back and forth stuff, I really, what I'd love to see is something like the yen would have been brilliant to trade recently, over the last couple of years, because it's just been in such a bear trend. Or you could have bought anything against the yen and just held it and done well. Okay, we're coming up to the end now. Are there any more questions? Because we've only got about 3 minutes left, so there's not really much point in getting into any other market. I will actually just show you the euro US dollar. It's such a big pair. It's rude not to. There we go. That's your daily chart for the euro US dollar. Another one which is just stuck in a really erratic sideways move. We had a winning trade there actually. I'm happy to say we sold it around 107.50, 107.70. That was my sell level, and we did manage to reverse from there. But I'm really struggling to get really good low risk trades where you can, for my subscribers, I find trades that you risk kind of 20, 30 pips to make 40, 60, 80, even sometimes 100 pips, and they're becoming rarer and rarer. Gold has been quite good for us, but I must say, yeah, we need some moves that last more than a couple of days in one direction. Yeah, the moving averages, you can tell when the market's in confusion because the moving averages start to flatline and converge. And we've seen a lot of that recently. I'm going to show you the Aussie dollar. We were talking about it earlier. This is the Aussie versus the US. And this has just been in a real serious sideways chop for a very long time. And again, you can see the moving averages have all converged now and are moving sideways. Even the ranges have decreased quite significantly. Okay, well, look, there you go. That's the hourly chart for the Aussie dollar. That really does show how we're just moving in a sideways range for months for the Aussie dollar. That's quite typical of what's been going on lately. I can draw some trend lines on there which emphasize that fact, I guess. There we go. Okay, I think we're pretty much done. Thanks very much for joining me. Please join me next month. We'll have another one, or we'll have another session. And if you do want to contact me, I did give you my website earlier. But if you do want to contact me, I've got all my personal contact details on my website. So you can WhatsApp me, you can email me. And there you go. Oh, hi, Nick. How are you? Good to see you join us. Yeah, the website, I think I've just typed it out for you, but here it is again. daytradeideas.co.uk. And if you want to Google me, you can find my YouTube channel, Have a look at my YouTube channel. I've got some good videos up there lately. Yeah, you can find lots of content for me. All my social media channels if you Google my name. And there's my email. Thanks, guys.